All right, let's just get right into it. Have you ever stopped to wonder why so many traders, even the ones with really good strategies, still end up failing? Well, the answer is way simpler than you think, and honestly, it has almost nothing to do with their ideas. It all comes down to their expectations. Today, we're going to break down the one mindset that truly separates the pros from everyone else. Trading probabilities, not outcomes.
And this quote? It just nails the core problem. See, most of us jump into the market craving certainty. We want every single trade to be a winner, and the second it isn't, our whole world gets shaken up. It's that constant need for a guaranteed win in an environment that is, by its very nature, uncertain, that puts us on this destructive emotional roller coaster.
And when you're stuck thinking like that, every trade becomes this big test of your skill, of your strategy, of you. A win makes you feel like a genius, right? But a loss makes you question everything. And that, right there, is the killer. Because when a loss feels personal, it absolutely demolishes your ability to stay consistent and just execute your plan with discipline.
So this whole emotional way of thinking, it basically leads you to a fork in the road. And every trader, whether they know it or not, chooses one of two paths. On one side, you've got the gambler, who's totally driven by emotion and that desperate need for certainty. And on the other, you have the systematic trader, driven by process and, an acceptance of uncertainty. Let's really break down what that means.
Okay, so this lays it all out. The gambler, they're judging every single trade by itself. They tweak their rules after every single loss, and they totally panic during a drawdown, which is just a normal string of losses, by the way. But the systematic trader is the complete opposite. They judge their performance over a huge series of trades. They execute like a machine, and they get that drawdowns are just a statistical reality, not some kind of personal failure.
So here's the most important part. This has nothing to do with being smarter or having some secret algorithm. It is a fundamental shift in perspective. That's it. It's about moving your focus from the random outcome of one single trade to the statistical edge that only, and I mean only, shows up over time. And anyone can make this shift.
And that really is the bottom line, isn't it? A single trade can't prove your edge, and it can't disprove it either. It's just one tiny data point in a huge ocean of probabilities. You need hundreds of trades, hundreds of executions to see if your strategy really has a positive expectancy. One trade is just noise. 100 trades, that's where you find the signal.
Okay, so let's shift gears from the mindset to the actual math that holds this whole philosophy up. We're going to walk through a really simple, totally objective example that shows exactly how this works in the real world. And I think you might be pretty surprised by the result. So let me ask you this, because it kind of challenges everything we're taught about success. We're all conditioned to believe you have to be right most of the time to win. But what if I told you that you could be flat out wrong almost half the time and still make fantastic money? Let's see how that's even possible. So here are the rules for our little experiment. We're going to run a system for 100 trades. For every single trade, we're risking a consistent amount of our capital. We'll just call it 1R for 1 unit of risk. But when we win, our average profit is double that risk, or 2R. Pretty simple, right?
All right, 100 trades later, here's where we landed. We won 52 times, and we lost 48 times. That's a win rate of just 52%. I mean, to most people, that looks pretty mediocre, right? It's basically a coin flip. But now, let's run the numbers.
And the math here is dead simple. We take our 52 winning trades and multiply them by their average payout of positive 2R. Then we subtract the cost of our 48 losing trades, which was negative 1R each. So, what does that give us? A net gain of 56 times our initial risk. Let that sink in. This is the raw power of positive expectancy. Even though we were wrong almost half the time, the system is wildly profitable because our wins were just bigger than our losses.
But here's the part that trips up literally everyone. Those 52 wins and 48 losses, they don't show up in a neat little pattern. You could easily have 10 losses in a row before a big winner comes along. The sequence is random. But the profitable outcome over a big sample size, that is a statistical near certainty. And that's why traders quit. They just can't stomach the random sequence.
So, knowing the math is one thing, but actually living it day in and day out, that's the real challenge. So let's move on to what you can actually do about it. Here are 3 super practical habits you can start building today to rewire your brain to think like a quant instead of a gambler. Okay, first thing, stop judging your performance by the day or by the week. Judge it in blocks of trades, let's say every 100. Probabilities need room to breathe. Second, you've got to change the way you talk about your trades. Instead of saying, "Ooh, this looks good," you start thinking, "This setup has a positive expected value." And third, and this one is huge, you have to normalize losing. Losses are not failures, they are a required part of the damn model.
And let's just zoom in on that second habit for a second. Expected value, or EV, is the whole game. Think about it like a casino with a roulette wheel. They have no idea if the next spin is going to be red or black, but they know with absolute certainty that over thousands of spins, their little statistical edge will guarantee them a profit. Your only job is to be the casino, to just keep executing your system that has a proven positive EV. It completely takes your ego out of the outcome of any single spin.
All right, now let's get real for a minute about why this shift in perspective isn't just some nice little tip, it is absolutely critical for your survival in the markets. Because, honestly, the stakes could not be higher. So here's the really uncomfortable truth. Countless traders have systems that actually work, systems they've tested that have a positive expectancy, and they abandon them right before they're about to pay off. Why? Because a completely normal, statistically expected drawdown hits, panic sets in, and they convince themselves the whole system is broken. They never give the math enough time to actually work.
And this is a line you should probably write down and tape to your monitor. Seriously, the hunt for a perfect, no-loss system is a complete fantasy. A profitable system needs losses. Those 48 losses in our example, they're what made the 52 wins possible. You can't have one without the other. It's not magic, folks. It's just math. And what that means is we have to completely reframe what a loss is. It's not a signal that something's wrong. It's a predictable, priced-in cost of doing business. It's just like a restaurant having to pay for food and electricity to sell its meals. A trader has to pay with losing trades to get access to the winning ones. It's that simple. So, at the end of the day, it all comes down to this one choice. Are you going to keep riding that emotional roller coaster, chasing that feeling of being right on every single trade? Or are you going to finally adopt the mindset of a professional, stepping back and calmly managing a system with a statistical edge over the long haul? The choice is yours.